Okay, welcome to chapter 11. This is our last chapter before the exam, and it's on variances, which is the natural outcome of budgets. Budgets are what you plan for, variance are your comparison of actual results to the budget. We talked a little bit about that phenomenon in chapter 10 with regards to performance evaluation, but now we're going to look at it from a different angle. And frankly, chapter 11 has more calculation. Not tough calculation, but like a lot of the book, a lot of managerial accounting, it's just knowing what numbers to use where. The actual calculation is pretty easy. Let's take a look. So we're going to go over the first couple of questions. Now there's a little bit of front loading of explanation, so that's why we're just covering a couple of questions in this one. And then we'll finish up with the rest of them on the next video. So the first part of this is, although it's not a difficult concept, it's just understanding what is a standard cost. All that means is that when we're creating a budget, the real world is sometimes, for example, let's take a situation like if we're trying to figure out how much income are we going to have, we're probably going to multiply how many items we think we're going to sell by a standard price. Now, over the year, we could have sales, we could have discounts. There could be a lot of different actual prices throughout the year, but we don't really take that into account. Well, we don't really try and go through and figure out for each item what's going to be the price for each item. We come up with one average price or one overall kind of goal that we're trying to attain with price. So we would multiply what we expect the volume of sales to be times the standard price. And we would do that not only for top line volume and revenue, we would also do that for all the costs. If you're buying a bunch of things, you recognize that sometimes you might get a volume discount or there might be differing prices. But for the budget's sake, we're going to just set out one price or one cost and kind of carry that forward. Now, what should that cost be? Well, there's a couple of different areas of thought. You shouldn't make it too easy. In other words, you should make, what you think that your cost should be, you should make them challenging, but maybe not the world's best, right? Or the world's lowest. You should kind of create an area where we want it to be this, and maybe we'd have a stretch goal. So that would be the kind of the point here about create a cost that is realistic but challenging. Now, I mentioned kind of in the intro that in chapter 10, we looked at costs, we looked at variances with regards to performance evaluation. And that's just a natural outcome of how a business works. If you give your managers a budget and you want to evaluate how they perform to the budget, do they perform over or under? So that's one use of budgets and variance. Another use, and this is what this chapter is focused on, whenever you have a budget and then there are variances, in other words, actual results do not match the budget, you may be happy if the actual results are better, you may be unhappy if they're worse, but no matter if it's better or worse, you understand why. If it's worse, you want to understand how to fix it. If it's better, you want to maybe understand how to maintain it. Well, when we look at this, there's maybe a number of different ways, but in this chapter, we're going to look at two main ways of trying to have continuous improvement or how to improve the process. We're going to look at, did we get the quantity right? In other words, if we're buying a bunch of materials, did we use too many materials or too few materials? Or were we paying too much for those materials or too little for those materials? So we're going to divide up, we're going to say, here are the actual results. Here was our budget. Now, where did we differ? Was it a difference in the quantity that we used? Was it a difference in the price that we paid? Or was it a combination? And if it's a combination, which one was, I guess, the stronger influence? So we're going to look at, and sometimes it could be one would be a positive and one would be a negative. So we're going to look at, this is going to be for all these costs. And the costs that we normally associate with this book are direct materials, direct labor, and manufacturing overhead. Today, we're just going to go over direct materials. We're going to use the explanation and go through direct materials. That's typically the most, I guess, the simplest one to understand. And the rest of them follow the same pattern, but they use a couple of different terms. One other thing we should mention is we also use the word standard we also use the word standard when we're talking about cost per unit, and I'll make that a little bit clearer when we're looking down here at question number 1. The last thing is, well, just like in chapter 10, we're going to use not plus or minus, we're going to use the words favorable or unfavorable. And we have to remember it's situational. If your actual income is higher than your budget, well, that's favorable. But if your costs are higher than your budget, that's unfavorable. So it depends on what you're looking at. So that's why we don't use just plus or minus, because that doesn't give us enough context with whether it's good or bad. So we have to recognize that sometimes being more than the budget is good, well, income, and being less than the budget is good with respect to costs. Okay, so let's take a look at the first learning objective, which is just kind of understanding standard cost. And this isn't very difficult, this particular one, but it's getting you in the practice of understanding. And you'll see when we get to question 2 and 3 why we need to focus on understanding what is it that we're looking at. So if you notice here, the things I want to point out is that, well, we've got a standard direct materials per batch, right? So that's looking at each of these individual direct materials. This is direct material number 1. This is direct material number 2. This is direct material number, well, this writing system always drives me crazy. Direct material number 3. So we could figure out variances for each of these. And if you notice that the unit that we're talking about is, and this is important to recognize, we can have the production unit. What is the production unit? And that is a fudge ball, is a 10-pound batch. And then we can have the direct material unit. So it's easy to get, I guess, mixed up between the two. So here, the direct material unit is, this is for sugar, it's per cup. The direct material unit here is ounce, ounce, ounce. So just make sure you understand that what you're looking at. When it says the standard cost for the production unit, well, the production unit is the batch here. And that's why I was saying up here, standard cost per unit. Well, what do they mean here? Do they mean the production? Well, I've already gotten it written down right here. Standard cost per unit, do they mean the production unit or do they mean the direct material unit? And it's important when we're figuring out variances that we know which one we're dealing with. So here, I'm not going to do them all, but I'll kind of just run through. You see the standard quantities for each of these ingredients are to make a batch, to make one batch. So to make one batch, we need 8 cups, 17 ounces of this, 16 ounces of that, 27 ounces of this. And the price, well, they give that to you too. This is 16, 15, and so forth. And you just multiply this out. And I've done it, but I'm not going to write it all down because this writing mechanism sometimes drives me crazy. So 128, 255, and so you would say the standard cost of this material for one batch is this amount. But the standard price per cup is 16 cents. So this is the standard cost of the material for the production unit, and this is the standard price of the direct material unit. So just be aware that that's, even though they don't really draw that out in the question, that's what they're really trying to show you is the difference between production units and direct material units and the price, the standard price between them. That's what I'm trying to draw out because we're going to need to know that when we get to the next thing. So let's look at direct materials. And I'm going to take a picture from the PowerPoint and from the book. And it's a pretty good picture, and I think we should kind of remind ourselves. So remember in the last chapter we had the, let's see if I got enough room. We have actual results, and then we had the master budget. Now, the actual results, let's say this is, let's say this is 150 units, right? And our master budget was based upon 100 units. Well, remember that we said we have to create a flexible budget that is based upon the same volume. In other words, if we're looking at costs, it's no use to look at the costs for 100 units and the actual cost for 150 units because that's not comparing the same volumes. So we would create a flexible budget. And we went through and we looked at some variances between actual and the flexible and the master. This chapter this is now actual. This is the flexible budget. So it's like we're now looking at this section right here. This is the flexible. In other words, this standard, and we'll get to this in a second. Can I draw on this? Okay, I can. The standard quantity allowed, and it kind of has this weird word here, is because we've moved the master budget volume up to the actual volume. And that, I'm going to come back and make a point of that a couple of times, because this is one of the things that trips people up. So in the number of textbooks that I've used, no one's really labeled this. So before we get to that, let's actually look at a couple of these components. If you notice, when I said in the beginning, what are we really interested in? We're interested in trying to analyze quantity and price, and where were we doing well and where were we not doing so well. And that's exactly what we're looking at here when we're looking at variances. We're looking at quantity times price. So if you notice here, this is actual quantity times actual price. And this is standard quantity, and this is where, we're getting the standard price. And then we have in between, we've got this sort of intermediate calculation. Actual quantity times actual price. Now, people, they don't normally name this, but I kind of name it and I call this. So if this is the actual results, this is the flexible budget, I kind of label this as the should be. In other words, if we took the actual quantity and we multiplied it by our standard price, this is how much we should have paid. Now, we actually paid this much. We actually paid this much. We budgeted this much, but taking the actual quantity times the standard price, this is what we should have paid if we had done that actual volume. So just be aware that this is my own kind of word for it, but it kind of helps us. And the important thing to remember is to not mix up the AQ and the SP. In other words, this middle part is not AP times SQ. It's not that. It is AQ times SP, and that will kind of make that. In other words, it's the standard price that we're looking for in the actual quantity. Because remember, the flexible budget is based upon actual quantity. So we have these three buckets, and what we're trying to do with these three buckets is we're trying to tease out these two things. We're trying to tease out the price variance, and we're trying to tease out the quantity variance. In other words, we have our actual cost and we have our standard cost, but was it because we paid too much for our materials, or did we use too much materials, or was it a combination of both? And by kind of using these equations, we're going to find out whether we paid too much or too little, or we used too much or used too little. And that's why we kind of separate them out, is because we want to see the variances on these, I guess, subcategories. Now, these equations are not that hard. Let's take a look at kind of how they're created here. Well, I mean, you can look at, it's this minus this, right? It's the left one minus the right one. And same with this one. It's the left one minus the right one. But that's one way to think about it. Another thing to think about it is, if we're trying to look at the variance of price, we're trying to look at the difference in price, right? Well, here, if you look at what's in the brackets, the difference in price is the actual price minus the standard price. Well, that makes sense. If we're looking at the difference in price, well, doesn't that mean we're looking at the difference between the actual price times the standard price? The thing that you have to kind of remember is you multiply that by actual quantity. And same with quantity variance. If we wanted to know the difference in quantity, wouldn't we subtract actual quantity from standard quantity? Well, that's one way to remember the quantity variance versus the price variance. So at least you'll be able to get the insight in the buckets. When I say price variance, well, that's the difference in price. Actual price minus standard price. Quantity variance, well, that's actual quantity minus standard quantity. I think the thing that is maybe going to sometimes tricks people up is that with the quantity variance, you use one of the price, right? Obviously, you can't use a quantity, so you're going to be using the price. It's just whether you select the right price on this side and whether you select the right quantity. So you can get in the habit of maybe remembering the actual quantity and the standard price, but the interior part and which one it is should be pretty clear. Price variance is the difference price. It's the actual price minus the standard price multiplied by, and this is the thing you probably have to remember, actual quantity, etc. One other thing I just want to kind of mention is, you notice that I keep saying standard quantity, and I think in some other textbooks they use it, and here they use standard quantity allowed. I think this is just kind of an indication of, we need to remember that this standard quantity allowed is based upon a flexible budget mentality. And we'll see what that means here in just a minute. But these are the equations that we're going to use, and almost always the actual, you can see this equation is not very hard. Actual quantity, actual price, standard price. You just, subtract these two and multiply it by AQ. The problem is, you can see that there is 4 items. Actual quantity, actual price, standard quantity, and standard price. Now, what they don't bring out in the book that I want to kind of mention here is, before you do once you look at a homework problem or a test problem, I almost always recommend first write down these 4 things. What are these things? And before you do those 4 things, you have to know 2 things. What is the production unit? Boy, it just does not want them. There's some autocorrect going on. And what is the direct material unit? Because sometimes in the problem they give you both, and you got to make sure that you understand. Now this actual quantity, actual price, standard quantity, standard price, this is for your direct material. These are for your direct material. Now, another thing to remember, actual quantity is based upon the total quantity. The price is based upon the unit price. And same with the standard quantity. This is the total. And this is the unit. So if you can map these 4 things out, plus identify the production unit versus the direct material unit. Now, a lot of times, like some of these will be given. Some of these will be given, and then some will be calculated. In other words, they'll give you the information necessary to calculate it. So you have to recognize when something is given and when something needs to be calculated. So once you get this information down, then the actual calculation is pretty easy. It's very straightforward. So don't rush to try and plug in numbers. I would suggest that you first stop, write these down, or at least mentally identify, underline, look at them, whatever. Make sure you identify what these items are, because it'll help you from getting confused in the problem. Well, let's take a look at a problem. And if you notice, this doesn't show up on the homework. This is how it looks on the homework. But I have actually outlined these so that we get in the practice. And this will help us with the other homeworks as well. Okay, so this first one here is the company makes planters. Okay, well, that's our product, right? The standard quantity of clay used for each planter is pounds. So if you look at up here, we were looking at something that had a bunch of different direct materials. This had 4 direct materials. So this planter may actually have a whole bunch of different direct materials here, but the direct material that we're actually looking at is a pound of clay. And understanding this direct material unit, so when we come down and we're trying to figure out what's the standard price and what's the actual price, we're going to realize it's not the actual price or the standard price of the planter. It's the standard price and the actual price of a pound of clay. So that's part of the reason of pointing out to yourself, making sure you identify the difference between these two, because they may give you, like here, the company produced 4,000 planters, but that's not the direct material in question. So here, let's take a look. Well, we can go through, I guess there's no particular method, because sometimes they give you, it changes with the problems, which ones are given and which ones you have to calculate. So just kind of glancing here, I can see in that month, 76,000 pounds of clay were purchased. So not were planning to be purchased. So the important thing is here is now we're talking about our direct material. So that is our quantity, right? Our quantity of the unit of the direct material. So that was the actual quantity, 76,000. So not 4,000 planters. We're not so concerned about planters. We're concerned about the direct material. And you notice that it says was purchased, meaning this is an actual quantity, not a standard. And the other thing to notice is it's not saying how heavy is 1 pound of clay, was what is the total amount, total pounds of clay. Now, if I go through here and I look and I say, okay, it gives us the standard cost of $2.10. That's what we're budgeting. We're saying we plan on spending $2.10. How much did we actually pay? So here, when I look at the standard price, and once again, it says per pound of clay, so I know we're not talking about a planter. So they could give you, they could say a planter costs this much and a pound of clay costs, or we budget, we sell planters for this much and we budget the standard cost for a pound of clay is this much. Well, you'd have to recognize it's the second thing. It's the pound of clay that you're interested in, 210. So, and once again, remember, the prices are in units and the quantities are in total. Well, do we have an actual price? In other words, how much did we actually pay for each pound of clay? Well, we see that we have a total of, we spent $152,000. Well, if you put $152,000 and you look at your standard price per unit, in other words, if I put this here, $152,000, if I said $152,000, another double check to see if you're doing things right is, are these on even the same scale? So our budgeted price is $2, but our actual price is $152,000? Well, that doesn't make sense. That's the total amount. We still want to have the per unit actual price. So here we're given the 76,000 of how much we purchased. So if I just divide those out, right? If I divide those out, I'm going to get to $2. Now I can kind of compare these two and say, are these kind of on the same I guess magnitude? $2.10 budgeted, actually paid $2. Okay, that's reasonably close. In other words, it's something that I think that we would compare. We wouldn't compare $2 versus $152,000. And I see that quite a lot on a lot of tests, is that people don't take the extra moment to make sure they've got the right number. So in other words, there's not many numbers here, but they don't give you all the numbers. They give you two, and you have to calculate two in this particular problem. Okay, so standard quantity. And actually, I'm just going to kind of throw out there, this one is usually the one that kind of throws people off, the standard quantity. So would we say 4,000 planters? The company produced. Well, that's an actual production, right? Well, and plus, it's not even in the direct material unit. So this is where I said, remember the standard, and then in the book it calls this standard quantity allowed, right? And I said this A, remember this A has something to do with the flexible budget, or with the idea of a flexible budget. So if the company produced 4,000 planters, and we want to know what would the budget be, for pounds of clay? Well, remember the flexible budget is moving the master budget up to the same volume of actual. So if I said, if I had budgeted 4,000 planters, and I know that my standard budget is for each planter, I plan on using 18 pounds of clay. I don't know how much I actually did, but that's what I plan on it. I would say 4,000 times 18, and that actually comes down to 72. Comes out to 72,000. And once again, just like I compared the $2 versus the $2.10, I can compare the 76,000 versus the 72 and say, okay, those are on the same magnitude. Well, with that, I actually now have all the numbers I need. So I would just go through and say, okay, 76,000 times the actual price, which was $2, minus the standard price, $2.10, is going to be a price variance. Oops, I forgot to take this out. Of 7,600. Now, I'd have here favorable, but if I didn't know that was favorable, how would I guess? Well, look right here. Remember we were saying it's kind of situational. Well, we're talking about costs here. The actual cost was less than my budget or my standard cost. It was 10 cents less. So this is going to be favorable because we actually paid less than we had budgeted for. So this is favorable. And if we come down here, so this is the price variance, and this is the quantity variance. Now for the standard price, we have $2.10. The actual quantity was 76,000. And once again, I left the U in when I shouldn't have. The standard quantity is 72,000. So even before we calculate this, the actual quantity used was more than the budget. What we actually ended up using was more than what we had planned for. So no matter what the number is, this is going to be unfavorable. And the actual number is 8,400. So when we look at these two and we compare them, overall, when we combine these two and find in other words, if we go back up to this chart, we're going to take the price variance and we're going to combine it with the quantity variance to come out with the total direct materials variance. Our total direct materials variance, when we combine those two, is going to, well, we just take, think of it as like a line here. This is the favorable side and this is the unfavorable side. And you kind of say, okay, well, we increase the favorable side by 7,600, and then we decrease it to the unfavorable side by 8,400. And so our total is going to be, well, what is that? Looks like that's 800. 800 unfavorable. So if we had just calculated the direct materials variance and we said it's 800 unfavorable, if we had just looked at that, we might have said, oh, that's pretty close. Yeah, it's a little on the low side. Let's see, did I do that right? 6, yep. It's a little on the low side, but it's not terrible. We wouldn't actually get the information we need to kind of improve our business. Once we separate price from quantity variance, we'll see that we actually did really well on price and really poorly on the amount that we used. We used way more than we should have, even though we were getting a good price. And in fact, the way more that we should have used was outweighed the favorable that we got on the price. So the buyer did a good job. The manufacturer was not doing a good job. So let's take this same thing. Oh, here are these mysterious marks again. Let's do this same thing with the next one. And the truth is, what I've just done here is the majority of this chapter. In fact, I think it's almost everything in this chapter. However, this benefits greatly from repetition because it's not, well, once you do it as many times as I've done it, it is pretty intuitive. But I completely understand, and look, I left the unfavorable and favorable again. I completely understand that from the student's point of view, the first time, second time, third time you go through this, it's not super clear. So I'm going to be doing the same thing, and this is just the direct materials. We'll be doing the same thing with direct labor and to some extent with the manufacturing overhead. So let's just make sure we got our process right and do this again. So I'm going to kind of talk through it maybe a little more quickly, but of course you can go back and rewind and watch it. So I'm looking at this. The company makes landscaping boulders, and the product that we're interested in, the particular direct material in the boulders is this resin. Perhaps there's other things, perhaps there's coloring, perhaps there's little pebbles to give it realistic look or whatnot, but the direct material that we're analyzing is the resin. So the product itself is the boulder, right? And the direct material unit is, well, it's a pound of resin. And I go through here and I say the company produced 2650 boulders, uses a standard cost of $2 per pound. Okay, so I'm going to throw here and I'm going to say $2. And if you notice, that was given. I didn't have to calculate that. And made 2650 boulders in that month. 12,500 pounds of resin were purchased. Okay, 12,500 pounds. That's the actual. And remember, I'm focusing on pounds of resin. You notice I skipped over boulders because that's not the thing that we're analyzing. We're not analyzing boulders. We're analyzing the direct material unit. We're trying to figure out the variance of the direct material. And the variance of the direct material, well, our actual usage, our actual quantity, and remember this is in total, and remember the prices are in per unit, is 12,500. At a purchase of 226,000. Well, this is very similar to the last one. That we want to know the price per pound that we actually paid, but they don't give this to us. But they give us the information necessary to figure it out. So 26,000 divided by 12,500, that's going to be equal to $2.08. And the standard quantity, well, what do we have here? Oh, did I do that right? Yeah. Sorry. I'm going to back up just a moment here. So it says 12,500 pounds of resin were purchased, but that's not how much were used. 12,250 pounds were used. I wonder, did I make the same mistake up here? Oh no, I kind of identified that correctly here. It's worded a little bit differently, so I just was double checking. Because just going through here. So here, this 12,500 is used to figure out the cost. What we're looking at here is the usage. 12,000, and it's a very similar number I see. 12,250 were used. But the price is 26,000 divided by 12,500. Yep, that's right. So the standard quantity, well, remember, this is our flexible budget idea. So think of this as flexible budget. If we produced 2,650 boulders, right? And we want to know what would, if that was our budget, if that originally was our budget, was to produce 2,650, well, how many pounds of resin would we have budgeted? Well, our budget is 5 pounds, that's a 5 pounds per boulder. That's our budget, the standard quantity. So if I had actually, once again, the idea of the flexible budget, move my budget up to the actual quantity, if I multiply those two out, that comes to 13,250. So once I've got these numbers, and you notice 2 were given, and 2 had to be calculated. And again, the plugging in is the easy part. So the actual quantity here is going to be, is it 12,250 times actual price minus standard price equals price variance of, let me just double check that. Well, I've got my thing here. So this comes out to 0.08. Oops. Times 12,250. Or 0.08. So I think I may have made a slight mistake in my calculation before. So this comes out to 980, but if I use the other number, so I think maybe when I was first figuring it out, it came out a little wrong. So I had originally put 1,000, but looking at the actual quantity, I should be using 12,250 here. Standard price, $2. And the reason why it's unfavorable is because my actual price that I paid was more than my standard. So I actually paid more than I had budgeted. So standard price times the actual quantity minus the standard quantity, well, we can see here we actually used less than our budget, and that came out to 2,000. So we have 1,000 or 980 unfavorable and 2,000 favorable. So this is going to come out favorable, but quantity used, the price variance was we're spending too much, even though we're using less than what we had projected. And I'll just throw this out there, even though it may not be a point in the book. Don't be so overly joyed if you're using a lot less, because a lot of times problems come when the manufacturing uses too little. They don't use enough ingredients. In other words, if this was the specs and you budgeted, that having too low a quantity variance may also be a problem, just because you may be underutilizing the material. You may be not putting enough material in the product. But in any case, so you would combine those two and you would come out to have a favorable variance, but you would know that the quantity was very favorable and the price was unfavorable. Okay, so we're going to do the same sort of thing with direct labor and manufacturing overhead in the next video. And it's going to be similar, but once again, I think this chapter benefits from repetition and kind of just looking at the small differences with labor and manufacturing overhead. Okay, thank you very much.